One of the tools I use to evaluate stocks is a discounted cash flow analysis. This method values a business based on the discounted cash flows the company is expected to earn between now and infinity. I teach this to all university students in my finance courses. This is more technical than what I usually do in my videos because I like to keep my videos more accessible to as many people as possible without intimidating anyone away from investing in stocks. Wall Street does the opposite by actively trying to persuade people that investing is too complicated, so you should just hand over responsibility to them. In this video, I'll share with you the details of my discounted cash flow analysis for Nvidia stock. I will warn you that there are several estimates and assumptions used to create this valuation. And unlike other price forecasts I've made about Nvidia, which try to predict where Nvidia stock price would be at some point in time in the future, in this video, I'll highlight what I think Nvidia stock is worth right now, today. How much is it worth? So there's a lot to cover. Let's start evaluating the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so 4 different parts here to my free cash flow valuation example for Nvidia stock. And I'm going to start right up at the top here where we are forecasting cash flows for Nvidia going out 6 years. Now we're going out 6 years. We're going to find the horizon value in year 5. I'll explain what that is. I'll go through each of these parts step by step, explaining all of the numbers, detailing where I'm getting the numbers from, and finally finishing with the intrinsic value per share of what I think Nvidia stock is worth. So let's start with the 2024 free cash flows for Nvidia. Now I got this number from Nvidia's cash flow from operations over the trailing 12-month period, which were $48.66 billion. And I subtracted the capital expenditures in those trailing 12 months. And that's how I arrive at my free cash flow number for 2024. Now, I also use that number to forecast Nvidia's free cash flows 6 years into the future. As you can see here, $69 billion 2025 estimated for Nvidia's free cash flow, $101 billion estimated in 2026, $149 billion estimated in 2027, and $218 billion in 2028. And that soars to $321 billion in 2029 and $337 billion in 2030. The growth rate I used to forecast these cash flows for Nvidia was 47%. 47% increase in cash flow expected for Nvidia over the next 5 years. And then for the 6th year, I used a long-term growth rate of 5%. The reason I used 47% as my growth rate for free cash flows is because the analysts on Wall Street that are following Nvidia stock, they estimate its earnings per share will grow by 47% each year for the next 5 years. So remember, this is what they expect its earnings per share to grow each year over the next 5 years. So I've used a earnings per share forecasted rate to forecast free cash flow. All right, so that's one difference from the estimates. Now, I highlighted in the introduction of the video that I'm using several estimates and assumptions to make this stock price forecast. And already I made an adjustment to an estimate, a Wall Street estimate. So we're going to do a lot of that in the video. So I'll share with you precisely where I'm making estimates and where I'm making assumptions so that you can follow along and make your own judgments. So that's where I got the 47% increases here in the cash flows expected. And so since these cash flows are expected in the future, all of us should want money today instead of money at some time in the future. If you promise me $1 today or $1 tomorrow, I'd rather have the dollar today because money is worth more to us the sooner we can get it. And so those cash flows we're expecting in the future, we have to discount them because they're not as valuable to us in the future as they would be today. So underneath those expected cash flows, I have the present value of those cash flows expected. So in sum, those present values of the cash flows expected over the next 5 years are worth $740 billion, the present value of those cash flows. The discount rate I'm using to discount those cash flows is a weighted average cost of capital of 12%. To arrive at the weighted average cost of capital, I use the capital asset pricing model to come up with the cost of equity, and I got a beta of 1.67 for Nvidia stock. I got this beta from Yahoo Finance. I used the risk-free rate of 3.5%. That's approximately what the 10-year U.S. government bond will give you. So that's the rate I used for the risk-free rate. And the market risk premium I used is 6%. Historically, the market risk premium has averaged between 4 and 6%. I used 6% in this example. On the higher end of the market risk premium expected, the higher market risk premium you use, the lower your valuation will become. So using 6% instead of 5 or 4% is a more conservative estimate for Nvidia's stock price. So since the company's total capitalization is about $51 billion and they have total debt of about $11 billion, these are estimates here, I rounded. The debt to equity here is about 21% debt and 78% equity. And so when you're arriving at the weighted average cost of capital, since you're getting capital from two different sources, from debt and equity, you get the average of what the cost of debt is times how much debt you're using in the company times how much the cost of equity is and the percentage of equity you're using in your company. You bring it all together, you get the weighted average cost of capital of 12%. That's what I'm using to discount the cash flows, and that's the discount I'm using throughout the video. Now, the long-term growth rate I'm using for Nvidia stock is 5%. So I'm assuming that for the next 5 years, Nvidia is going to increase its cash flows at 47% per year. And then from year 6 to infinity, I'm assuming Nvidia increases its cash flow at just 5%, Now, if I was to try to be more precise with this valuation, I would have created a blended decrease. So instead of going abruptly from a 47% growth rate down to a 5% growth rate, I would have created more of a transition. Let's say from 47 down to 30, down to 15, and then down to 5, because that's generally how companies slow down. They don't experience an abrupt slowdown. They experience a gradual slowdown in growth from their fast-growing stages, like where Nvidia is in right now. So when I'm using my horizon value calculation, I'm using that 5% growth rate as the long-term growth rate. And this is the value of Nvidia's cash flows between 2030 and all the way out to infinity. So instead of forecasting each individual cash flow from now until infinity and discounting those individual cash flows all the way back to today, which I could have done, when I use the horizon value, I'm collecting all of those cash flows from the year 2030 onward and bringing them back to this point in time in 2029, and I get a value there of nearly $5 trillion of valuation for Nvidia's cash flows expected between present value of cash flows expected between 2030 and infinity. But I also need to discount this value back to today because this is 5 years from now. So when I discount the horizon value back to today, I get $2.8 trillion for Nvidia's horizon value. And you can see here, the present value of the cash flows between now and 2029 is $740 billion. The present value of all the cash flows between 2030 and infinity is close to $3 trillion. So the bulk of Nvidia's valuation relies on the cash flows you're expected to get between 2030 and decades into the future. And that's true with most companies. Now, if we combine these, the total value of operations, I get approaching $3.584 trillion. But we're not finished yet. We're getting close. We're not finished yet. This is the value of the company's operations. But the company has debt and it has cash, which is valuable to an investor. You want to incorporate that, right? You want to add the cash because you're getting that cash when you buy the business. and you're having to be liable for the debt. So you want to subtract the debt. So I added the cash of the non-operating assets for Nvidia at $34.8 billion, and I subtracted the debt of relatively $11 billion. And now, if I was to take the number of shares outstanding, which they have 24.8 billion shares outstanding, you take the value of equity, which we arrived at by adding the non-operating assets and subtracting the debt, we get a value of equity around $3.6 trillion for Nvidia. And we divide that by the number of shares outstanding, we get an intrinsic value per share for Nvidia stock at $145.48. This is what I believe Nvidia stock is worth today, right now, as I'm making this calculation. So I've made several estimates on where Nvidia stock price would be in the future, but this is where I think Nvidia stock price is worth today. And notably, Nvidia stock is trading at a price that's below where I've forecasted. It's trading at $115 per share, where I'm valuing the company at $145 per share. And so since my intrinsic value is higher than the market price, I rate Nvidia as undervalued. And I've done that in nearly all of my videos. And whether I use the discounted cash flow approach or the multiple approach, I've come to the conclusion that Nvidia stock is undervalued. Now, I said that I used the 5% growth rate for Nvidia stock in the long term. I also conducted several different scenarios of slower growth rates to see what it would do to Nvidia's intrinsic value per share. So I have them listed here under various growth rates. So if the long-term growth rate is 4% instead of 5%, that would mean Nvidia's intrinsic value per share is $128, still above where it is today, but not by much. If the long-term growth rate is only 3%, then Nvidia's stock price intrinsic value should be $116 per share, which is right about where it's trading at today. So it looks as though if you were to assume that the cash flow forecast is correct, then the growth rate that the market is assuming in the long run for Nvidia is 3%, although that would be an imprecise conclusion to draw. And if we go to a long-term growth rate of 2%, then Nvidia's intrinsic value could be $107 per share, which would be below where it is today, which I think a 2% long-run growth rate for Nvidia stock is way too low. So there you have it. There's my discounted cash flow valuation for Nvidia stock. And as I highlighted, I used several estimates and assumptions. This is an imprecise calculation. We're looking at the future. Nobody knows what's going to happen into the future, especially not myself. And this should be for informational purposes only, entertainment purposes only, and just a tool that you use among very many other tools in your due diligence in evaluating stocks to come to a final conclusion on whether or not you think the stock is a buy, hold, or a sell. It should be one of the tools that you use in your toolkit. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.